Welcome to the Coverage and Coffee podcast. My name is Caspar Harse. Joining me is Mo Mirzan, and that's the news.
Yeah, we really do have to come up with a better line than that,
Yeah,
unfortunately.
well, I mean, we'll change it every time. We'll see what sticks. How you doing, Mo?
I'm good. I think the weather's starting to turn in London. So we're starting to see the clouds start to form. The British summer is officially come and gone.
Yeah, the post summer blues have definitely started. We have been spoiled infinitely here. Um, but enough about the weather. We are going to be talking about insurance, which is not the most exciting topic, as many people know. I don't think a lot of people have very compelling relationships when when it comes to insurance. But we are going to try to add a little bit of a more contextual, more familiar and comfortable perspective on talking about insurance as a concept and talking about it as an industry. Mo, there was a podcast that you like to listen to that I think we're drawing some inspiration from.
Oh gosh, yeah, gonna call me out straight away here. Yeah, I think a lot of the ideas behind how we wanted to look forward and format this podcast is based on what the show Odd Lots has done really well. For those who don't know, Odd Lots is a podcast on the Bloomberg network, and it's very much based on the concept that the book Freakonomics drew upon, where they found these really interesting sort of niche situations in finance, and then brought on sort of experts in that field to really go on a deep dive and explore that, as well as bring it down to a level of understanding that a broader audience could sort of interact with and explore.
Yeah, so on that note, we will, we'll be going through different articles. We'll be talking about topics that we just kind of find, interesting to ourselves, as well as having a handful of different guests at times to come in and provide their opinions. Hopefully, be able to leverage some of their experience, some of their specialty knowledge to answer some of the, the hard hitting questions within insurance. Um, but I think that we should probably start with a little bit of an intro. Do you want to take us away, Mo?
Yeah, absolutely. So, I mean, first things first, why are we interested in insurance? My background's actually not strictly in insurance. It's been a bit of an odd path to where I am now. I met Casper back in UBC for university, where I was studying applied biology with the hopes and dreams that I'd become a doctor one day. I didn't. Spoiler. Ended up sort of going into finance. Worked in finance both in Dubai and in Hong Kong. And then when this bright young man decided uh, to come up with a wonderful idea, I thought this is about as good a time as any to take that leap of faith, and found myself in the world of insurance. But Casper, I mean, your background is perhaps a bit more linear in terms of insurance. What?
Yeah. So yeah, we met at university. I was not studying to be a doctor. I was doing international economics and finance, a little bit different. But I actually, you hear this a lot in insurance. I mean, many people, there's so many different paths to getting into it. Do you have a math background? You get into actuarial sciences. Do you want to work in sales? There's a lot of, insurance positions related around sales. But for me, I think, and a lot of people stumbled into insurance. Mo kind of got dragged kicking and screaming, as you can hear. But I think most people, they stumble into insurance a little bit. And I graduated from that university in the middle of the pandemic, and some of the other jobs that I had lined up, they changed their offer options. Things were very uncertain at that time, and I was thinking back to my internships and my previous experience within risk management, and lo and behold, a job opportunity comes to join Aon, which is, for those who don't know, one of the world's largest insurance brokerages. And I was in the group of people who did not know when I applied. I wasn't actually entirely sure what Aon did. Um, and that led me to joining their rotational program within commercial risk. So that involved me doing broking, account management, And then very quickly led me to joining their data analytics team, as the insurance industry was not the most technologically advanced industry.
Still isn't.
Still isn't. It wasn't back then, and it still isn't. But um, after working on internal initiatives there, we've decided to branch out and pursue our own thing. But that's probably something that will come more into flavor as we bring on specific guests than it will today. Um, that's kind
Yeah.
of the background, right? And now we've kind of run into this, I guess, common opinion with a lot of the people we've met, that insurance is not quite as sexy as it used to be of an industry, right? There's not as many young people. There's plenty of young people. Don't get me wrong. You go into Lloyd's, you'll see the youth there, but there's not as much of that common culture pull that I think the industry was used to when it really boomed, you know, 70s, 80s, 90s, and it had this culture that was built around it. Um,
Yeah, I think it's funny you say that because from a culture perspective, it would appear that um, at least for insurance brokers, it is, quite similar to how stockbroking in finance used to be, maybe in the 90s or so, in terms of the focus on the relationship aspect between parties in the industry. And, really today, with everything being work from home, digitized, you don't really see an awful lot of that.
yeah, no, I mean, in other industries, I think work from home has led a lot of people to coming home. But I think Lloyd's was one of the first to start mandating people to come back into the office. And Lloyd's, for those who don't know, is a massive wholesale insurance marketplace right here in the city, right here in the center of the city of London. And I'm not sure if the term comes specifically from insurance, but we have met a lot of what would you call twats. And it's not, we're not talking poorly on insurance people. It is a friendly banter type terms
Are we
for
allowed to say that? I'm not trying to get cancelled on the on the first episode.
that refers to people who come in on Tuesday, Wednesday, and Thursday. So there's still that hybrid approach, but there's still a very much important focus on coming into the office and talking to people. I think we can say these things. I think that um, you need a little something to say,
A
and
little
that's a
edge.
little edge. But I think that it's important that insurance feels more approachable, because even when I worked in the industry, right, like when I worked at Aon, when I worked internally at a big company like that, you can feel like one piece of a very very big machine, but visualizing that machine is so difficult until you are forced to interact with all those different cogs, right? Where you start to meet with people who work at MGAs, who work at syndicates, who work at capacity providers. You start to meet with people who work at underwriters, or personal lines, wholesale, retail, brokers of all the different kinds of varieties, and you start to realize that insurance is so much more than a single person paying a premium, and then if something goes wrong, you get paid out. There's just so much more to that entire dynamic, I think.
Yeah, no, I think that's super true. And I think that provides sort of the perfect stepping stone for perhaps exploring maybe some of the more misunderstood parts of, insurance, the difference between commercial and personal lines, and um, maybe trying to break down all these sort of terms for a wider audience, because it is a very term rich sort of industry.
It is, and I think that if we start with the personal lines insurance, because that's everyone interacts with personal lines insurance in some way, shape, or form. You have car insurance, you have house insurance, you have bike insurance. We actually just saw that the other day, or first got introduced to that the other day. So there's a lot of different types of insurance that are the within the industry. And for most individuals, it ends up being an inherently negative experience dealing with insurance, right? You're talking about there's two major ways that you as an individual interact with your insurance company. You're either providing premium and you're getting seemingly nothing out of it, right? Next year you got to provide premium again. Nothing bad happens. You never actually use the insurance you have. or something bad happens and you getting paid out by your insurance company is not a nice thing that occurs. That is the byproduct of something bad, right? Like the opportunities you have to form a good relationship with insurance are non-existent, really.
Yeah, no, I think just purely from an emotional basis, it's almost an inherently painful industry to experience, both for personal and commercial.
Yeah, and we've been to a couple conferences where people kind of talk about this experience. There's different technologies out there trying to gamify insurance, trying to build communities or provide benefits that are, a part of your insurance program to make it, that little bit better. But I think it's also kind of a byproduct of how normalized insurance has become, right? Because let's say you do crash your car or someone crashes into you or your house does burn down, and insurance wasn't there, all of a sudden it's way worse than it could be, right? But now we've come to expect insurance to be there in every place. Your flight gets canceled, your travel insurance kicks in. You break your car, you expect your car insurance to come in. The idea of that not being there has become so foreign that it's just a basis, I think, in terms of how people interact with insurance. It's just assumed that you're going to have it in some way.
No, absolutely. And I think especially with regulators almost mandating insurance in pretty much every field, you're only going to see more and more widespread adoption of insurance in newer and newer risks, right? I think just the other day we attended an event where people were exploring the risks about AI, a very nascent field, but one that's being sort of adopted all across the spectrum.
Yeah, and I actually think bringing up AI, I think is a fantastic way to then segue to the difference between commercial and personal, because for the personal person, it is a negatively inherent experience, but for commercial reasons, for companies, insurance is a mandatory requirement of operations, not only regulatory wise like you suggested, but also if these companies had to put money aside, have their own rainy day funds for these types of scenarios, they wouldn't be able to grow, they wouldn't be able to pay their employees at the same rate that they're doing today, right? Because the risks of certain fields of operation, let's go with a very extreme example. You have a cargo ship, right? Sure, there are huge, those are really high revenue, high cost industries. But if your cargo ship sinks, you're out for the count. You can't save that amount of money, right? Unless we're talking about a really, really big shipping company. But even then, that saving of money to put aside for a rainy day would be spread across the operations of everything they do, and everything would end up being more expensive there. Um,
Yeah, I think it really just boils down to an overall. I mean, when we're talking about commercial, it really comes down to a company's risk management strategy, right? Being able to spread out the risk of a black swan event happening across a longer period of time so that when that event does happen, you're not just immediately underwater. I think that really draws back to the very uh, to the concept of insurance in the first place and why it was formed. And I know we've talked at length about this, but the fact that it was formed in London initially, I believe, for the shipping company and for ships.
Yeah, I mean, insurance in many ways or forms have existed in the past, but the basis of modern insurance is from the Lloyd's of London. I think if you go to the Lloyd's of London, they do have like a little area where there's like a little mini museum, and they have a gift shop.
Really?
Yeah, they have a gift shop actually. You can get Lloyd's merch. Anywho,
Could you get like a little ship in a bottle? I've always wanted one of those.
I that sounds like something that they either should have or they could have. But they will really talk about the basis of Lloyd's being, shipbuilders and these explorers and traders would hang out in the pubs near the harbor, and they would realize that there are boats that go out there and they never come back. Right, something goes wrong, and the amount of investment it takes to get a voyage together. Okay, we're gonna buy all this. There wasn't the same communication that we have, that there's someone buying it and you're just a middleman shipping the boat, the goods around. You had to buy the goods. You had to go there, and then also make sure that there was someone to buy it, bring that money back. There wasn't money transfer or anything. So there were so many points of failure for a single expedition, and people would go to investors and be like, hey, we're going to go here and we're going to sell these goods or buy these goods and bring them back and turn a profit that way. And they would pull all their money together, and they would, hire the crew and go on these trade missions, and then the boat would never return, right? This would completely destroy anyone's livelihood if they were involved or invested. We're talking about a lot of money for these people. So they would go to these pubs, they would talk about these problems, and eventually they realized that if they each pay a little bit, they can collectively create a rainy day fund, because it wasn't every boat that disappeared. Some boats would never disappear. They'd make hundreds of successful voyages, and then all it takes is one unlucky or one unfortunate event with the weather. Um, and that kind of became the basis of insurance as we know it today, when people started going to these pubs, not because they actually had a boat, but because they realized that the chance of something actually happening was so minimal that they could make money facilitating this insurance of these boats. And then it kind of begins to scale from there. Um,
Yeah, no, I think it's such an interesting sort of history for the industry, and the fact that it's been historically sort of centralized in Lloyd's, and even after the Lloyd's building's been moved, and the fact that they've managed to preserve so much of that history in such a rich way, I think is incredible. Um, I will just say I would not have wanted to be one of those guys trying to calculate all the risks, um, and all the factors that might contribute to one particular voyage succeeding over another. I mean, that sounds like absolute hell.
Yeah, I mean, back then,
Yeah.
yeah, no, back then, I don't know how they do it. I mean, even today, a lot of the like, if we stick with the concept of marine insurance, a lot of the marine insurance around the world still goes through Lloyd's, right? In typical other industries, it would be a little bit, partitioned depending on size, depending on the exact route you're taking. But within marine, there's still a huge portion that gets facilitated within Lloyd's, and you know you look at the situation around the like the Suez Canal, right? When the Ever Given, that big container ship,
Oh yeah, yeah,
yeah,
yeah, yeah.
you look at the delays that occurred during the pandemic outside the port of LA, for example, and there were boats stuck out there for weeks. I mean, we met in Vancouver, and you could see the boats just hanging around out there, and how one delay can create another delay. And there are people who have contracts, and then there's contract insurance in terms of how do you deliver on time. And you end up realizing that when you look at an ecosystem, or if you look at a supply chain, right? There's so many different companies with so many different points of failures, and each one of those individual companies have their own insurance and their own points of failures, and all those insurance policies somehow connect, along that path. So even a modern voyage, I think, yes, it might have been a little bit easier than a little, napkin math back in the pub, but it's also gotten far more convoluted in terms of who pays for what in what situation. Um,
Yeah, no, absolutely. I mean, just untangling that web of liabilities and finding out, is it another party's insurance that's going to be liable for a particular claim, or your own, and how that's divided. It really is quite the convoluted mess, and I think is a key reason as to why insurance is so complicated even today. And I mean, I think with a lot of the new risks that we're seeing, it's only going to get more complicated, right?
did I ever tell you about the April Fool's joke I fell for this year?
Oh no, I do remember it. I can't remember the details. I do remember it was quite funny though.
Yeah, no. So as I do, I'm on LinkedIn, and I'm not exactly realizing that it's April 1st on this day. And we had just been talking about parametric insurance, Mo and I. We'll tackle that in a future episode, because that's probably a little too much scope creep for one podcast episode. But someone had made a LinkedIn post there saying that their insurance brokerage had now begun to facilitate parametric insurance for when ships get delayed, right? In the sense that they will pay you out automatically if your ship is delayed, which is probably the number one problem within, marine and within cargo. It's a joke because of how big of a problem this is. And if someone was actually able to do it, you would never make any money. You would never be able to provide insurance for something like this. And I remember telling Mo, and we had a meeting with someone that day, and I was telling them, and they were like, "There's no way." And I was like, "I saw the post about it. Like, it's got to be real." Just for me to get checked against that, it fell for it 2 weeks later or something because I got checked against the point that I had now shared. Um, and he was like, "There's no way." And I was like, "I'll find the article for you." So I find the LinkedIn post. Turns out it wasn't an article; it was a LinkedIn post. I thought they had shared an article. They just shared their own link. So you saw the little banner there saying it was a link.
The classic.
And then his next post the next day was, "I'm glad so many people liked my April Fool's joke." And I hadn't seen that one. I had seen the original one and started sharing it around. Oh my goodness. But it really just underscores your point in the sense that there are just so many points of failures and so many different points that, something can be insured, right? If I had gone to someone in an advisory position and said, "Hey, you should get this brand new parametric insurance from these guys," I would actually need, errors and emissions liability insurance. If I got paid as an advisor and I had shared that as a point of advisory, even I could have been insured for sharing someone's April Fool's joke as an actual fact, right? But still, that can't get insured. Kind of a crazy concept.
Yeah, it is. I mean, uh, especially sort of considering Lloyd's, maybe we should explore a bit more about how that dynamic works, the wholesale market, perhaps. It really is. I mean, until today, still the sort of the center of global insurance and where everyone goes to get all these weird niche risks insured.
Yeah, I mean, so commercial insurance for the most part is split into two segments, right? You got retail and you got wholesale. Now, there are many subsectors of those two types. There's many different types of insurance, but if we split it into marketplaces or types of insurance, there's retail and there's wholesale. Retail is a little bit more standardized. So this would be your mom and pop shop, but even let's say you have a scaffolding company in London, there is probably a standardized scaffolding, operations insurance or, a liability insurance if someone gets hit by your scaffolding. But then we start getting into more niche industries or more specific risk profiles where the scale ends up changing, right? So the primary difference between retail and wholesale has to do with scale, right? So if we're talking about you own your local supermarket, you have one property insurance. But let's say you have hundreds of supermarkets across London and your operations are different from the other supermarkets that have hundreds of locations. And all of a sudden, you start to need a little bit more specialty type insurance, right? That's when the insurance policy needs to reflect the operations more than the policy is standardized for a certain type of operations. And that's when you start going to the Lloyd's market. So a wholesale underwriter or wholesale broker will go to Lloyd's with a specific type of risk that they need insured.
Yeah, yeah. I think the classic example I love to use to maybe ground it for somebody who might not be familiar with insurance is, when you see these articles about a famous celebrity getting something insured, like, Taylor Swift with her legs or something, Lloyd's is really where they go to find the capacity to insure that risk.
Mm.
And I think that only really scratches the surface of all the bizarre kind of risks that you see that do get insured in the market. I know we were talking about this a while back, but I remember having a conversation with somebody who facilitated getting, what was it, hordes of yaks?
Oh, I'm so glad you brought that up.
Hordes of yaks in Mongolia or China, I believe, insured against mad cow disease. That was incredible.
Didn't it end up turning out that yaks can't get mad cow disease?
Yeah, so I believe, I mean, for the insurer, it was great because they were obviously just collecting premiums consistently, good premiums at that. Because obviously these massive, um, what is even the plural noun for a yak?
Yaki?
A collective of yaks, a crowd of yaks. I have no idea. Anyway, beside the point. Um, but I think they quickly found out that because Mongolia is landlocked, the risk of mad cow actually getting into Mongolia and affecting the bovine population there was incredibly low.
Mm.
However, that being said, it is still insured to this day. I believe who actually insures that risk is now a Chinese party, because obviously they looked once at the premiums and were like,
Mm.
yes, thank you very much.
Yeah,
Yeah.
but I think those three, or that little segue there, there's the you see those articles of Taylor Swift's vocal cords getting insured for 20 million. I don't know what the exact number is. You see these yaks that get insured, and you're like, okay, well, we have one example where it's someone individual having something very, very unique insured to them. We have another example where it's a very, very unique operation, and the chance of risk is completely unknown. So how does a traditional insurance company actually price something like that? But then there are other examples that are a little bit more, I guess, in the middle ground or common, especially here in London, especially a couple months after it happened, but Wimbledon as well, right? Um, do you want to explain Wimbledon?
Yeah, yeah, absolutely. No, I think that's a great example. So Wimbledon, the tournament itself,
It's
famously,
a tennis tournament.
sorry, yeah, tennis tournament, famously, were able to collect a pretty substantial payout for their pandemic insurance,
Epidemic insurance.
epidemic insurance. Sorry, pardon me.
Wording is important in insurance, folks.
It definitely is. It definitely is. It is very much an imprecise sort of science. But they took out that insurance policy after bird flu, so the SARS outbreak in 2003. And I have here, they were paid out following sort of COVID and all those related disruptions, around 114 million pound.
Yeah. It's it's
Crazy.
it's and when you see a payout like this, you'll sometimes see these like big insurance payouts, and you'll be like, um, you know, oh, they just made 114 million pounds, right? They didn't quite make 114 million pounds, right? I think their normal revenue is in a couple hundred millions per year. I think we talked about this once. I think they have 60 million pounds in profit each time they host the event. So it's a substantial event. 114 million is more, right? Why is it more?
In what sense?
Well, like, you would think that, okay, the event got canceled, they'll get paid out what they were supposed to make or something. What brings us to these kinds of figures?
Right, right. So now we're talking about the factors that go into how the claim is assessed and what the payout might be. Um, so I mean, firstly, for something like this, we're talking about business interruption costs. On top of that, we're talking about adjacent costs that factor into the revenue that the tournament might have generated, whether it be merchandise that they would sell over the period, and it really, really breaks down into almost a granular level.
Mm.
Um,
So
and
so yeah, I mean, I think 50% of it is business interruption, and then the other 50% is then the fixed costs, right? I mean, Wimbledon still has to maintain their courts. They still have staff that come on and have to do things on the courts. They may even have contractual obligations, right? I remember seeing some articles near the start of the pandemic where the classification that this was officially an epidemic or not was a really big deal when it comes to contracts, right? Because these were typically exit clauses for certain contracts, right? And then now we're getting into the specifics of wording. This is not just insurance, but this is like legal.
yeah, yeah, let's dive into that a bit more because I think this is extremely relevant now for what we're seeing in maybe Eastern Europe, right?
Hmm.
Um, Actually, a better example, perhaps, that's a bit closer to home because I am actually Malaysian. Uh, you might not be aware of this, but there was a civil war, but it was never technically classified as a civil war. There were these communist insurgents in Malaysia, and the entire affair was labeled the Malayan emergency. And why it was labeled the Malayan emergency over something like the communist war in Malaysia or something was because of Lloyd's. Because so many of the insurance policies that were taken out at that time in Malaysia had exclusionary clauses that would essentially void the policy if there were an outbreak of war in the region?
Yeah, the wording, at least where I worked before, was um, civil unrest, and that then included things like riots, civil unrest, and war. Right, and it's the other example you were talking about was Ukraine, Russia. Right, we everyone was very confused why at the start it's a special military operation, right? And at a certain point, like obviously, there was a little bit of role playing that the Russians were doing in terms of we're going to pretend it's a special military operation, then oopsie, we took over your country. But then they kept at it for a very long time, many months. They kept calling it a special military operation.
Is it not anymore?
No, now it's a war.
Oh,
Now
they've actually declared it. Oh,
it's
wow.
actually a war now. And that was actually Ukraine that had to call it a war.
I thought they always called it a war.
Yeah, but they actually had to declare war now. I'm pretty certain. But if
Oh.
you look, if you just search on Google, you can search like Lloyd's or facility or war. You will realize that a lot of these insurance companies have now created specific facilities to ensure operations that are taking places in war zones. Because guess what? Ukraine and Russia are still sending cargo ships out of the Black Sea. There are still trucks and trains crossing both sides of the border, to facilitate certain types of trade. There are still countries in Europe that are using energy that comes from Russia or comes from the Ukraine, and these are all things that would be traditionally uninsurable at this point. But in some ways, business and life needs to go on, right? And there were probably also parts of Malaysia that were unaffected by civil unrest or the Malayan emergency, and for them to even operate, because there's international trade deals and there's contracts that say you must have insurance, right? We will not do business with you. This contract is null and void if you do not have the sufficient insurance, right? So that's where then the contractual obligations meet the regulatory obligations. And we end up in this situation where wording is incredibly important, right? The specific phrases you use, the specific events that occur are incredibly important. And that bringing it back to some of the personal lines things we were talking about, this connects a lot to the experience that I think gets shared a lot when it comes to insurance, right? Because statistically, I don't know the exact figure, but it's really high how many claims the insurance industry actually pays out. But everyone knows someone who had a genuine claim which got denied, right? And they very quickly say, "Oh, well, it's because the insurance company was being very pedantic about wording," and it very much could have been. But there is a very specific reason why they're doing it. It's precedent, and it's also because of these contracts, right? They need to be able to ensure that a certain precedent is followed for all their wordings and it's interpreted the same way. It's also why you have the ability to go with an ombudsman or fight against a specific claim denial if you really think that it needs to go a different way. Um, but these wordings are so essential in insurance. It's really quite different from finance in that way, in the sense that when you go to a bank and you get a mortgage is a mortgage. Your APR is your APR. Your interest rate's your interest rate. I assume I'm looking at
Yeah,
you.
yeah.
Yeah,
No,
you're
yeah.
okay.
No, you're absolutely right. I think it is in insurance, it is that focus on maybe more of the qualitative aspects of how a policy is crafted, and um even just that gray area, that until a precedence is set, until a claim is taken to court, nobody really knows how a claim is going to play out by that particular contract. And I think that really does set it apart from maybe other sort of finance related industries. Um, but I think just by this conversation, you can see how much fun we have in exploring all these various sort of topics and subcategories within the industry. And I think you and I, we share quite a few conversations throughout the day about random topics all over the insurance industry, and we're barely scratching the surface. I don't want to run over time too much. It does look like we may have to begin sort of closing remarks.
I completely agree. We probably should, but I do want to throw in one last
Sure,
anecdote.
go ahead. Go ahead.
It connects to the last topic, so we're not completely changing. But back we Mo and I, we met in Canada. Canada is on the, what is that called? The Ring of Fire, right? Like the earthquake.
The West Coast, yeah.
Yeah, exactly. Um, and especially in Vancouver, where we met, the concept of earthquake insurance is incredibly important, right? But oddly enough, people can actually opt out of earthquake insurance for their specific house, right? So, in the event of an earthquake, you may not actually get covered if you decided to opt out. What's even more interesting is that if you go from insurance company to insurance company, there are some that call it earth movement and some that call it earthquake. And these things actually cover different things, right? Because let's say you have a landslide beside your house, earth movement would cover it. Earthquake, if it wasn't an earthquake brought landslide, wouldn't cover it. And what can get even more crazy is let's say you have an earthquake, it doesn't break your house is fine, but it does disturb the hill next door, and you then have a landslide. I'll leave that question to the audience. Is this a claim under earthquake or a claim under earth movement only? But on that note, I think we can start to wrap this up. Like we said before, we are trying to dive into specific topics. Today was a little bit more friendly and open. People who maybe don't know so much about insurance, we will try to bring people along the journey. But there are some topics that will probably jump feet first into. Um, but we do have socials. We are on various different socials, and we implore you that if you have any thoughts, or honestly, if you have any corrections, pop over to the LinkedIn. This is a little bit of a professional network. Obviously, we're reading the comments on YouTube, on Instagram, and we will try to bring some of those into these conversations. But it is a little bit of a professional topic here. So if you are on LinkedIn, find us on LinkedIn, drop your comment on the post for this podcast, and correct us, because that is probably going to be one of the number one comments that we end up getting. But that's one of the beauties of insurance, is that there's just so much to learn. And somehow I've made someone who loved finance get excited and giddy about insurance. And I think that right there is a small token of what's to come.
Yeah, I guess that is a bit of a win for you. But yeah, no, this has been the Coverage and Coffee podcast. We hope you'll join us as we begin to dive into various different topics with our guests that we're very excited to have on, and learn with us along the way, because we are quite young, I'd say. So we're constantly learning, constantly exploring, and we just hope that you'll be along here for the journey. Thank you very much.